This video shows the overview of discontinued operations and includes a short problem that is similar to something you have in the homework. Discontinued operations are portions of the business that a company has disposed of or is in the process of disposing of. The discontinued operations section of the statement of net income includes important information about the discontinued operation. A component of an entity has three main characteristics. It is a portion of the entity, it comprises operations and cash flows, and those cash flows can be clearly distinguished operationally for financial reporting purposes. A component of an entity can be a reportable segment, an operating segment, a reporting unit, a subsidiary, or an asset group. Companies report income from discontinued operations and continuing operations separately. Why? The separate reporting provides financial statement users with a measure of income from continuing operations, which is preferred for predicting future performance. Clearly, a discounted portion of the business will no longer generate future earnings and cash flows, so let's take them apart. Companies report three main types of income, gain, or loss under discontinued operations. In the examples that we've had so far, it's just been one line item on a trial balance that says gain or loss from discontinued operations. Well, as it turns out, it's a little bit more complicated than that. There's three possibilities. First, you can have income or loss from the operations that has occurred during the year. So this is the revenues, the expenses, the gains or losses related to those operations. The second piece has to do with the actual plant assets themselves, and there's two possibilities. The third bullet point is the gain or loss on disposal of assets constituting the discontinued operations. So during the year, you actually sold the assets, and so you can measure the gain or loss. Alternatively, if you're still holding the plant assets at the end of the year, you are required under GAAP to show a remeasurement of net assets to fair value less any disposal costs. So whenever you figure out your discontinued gain or loss, you're going to have two pieces. First, the income or loss from those operations, and second, you're either going to have the gain or loss from selling it or the gain or loss from marking it to fair market value. Now, these discontinued operations are always shown net of tax. I have added an optional assignment on My Accounting Lab, which includes the problems that I was planning to go over today in class. So here we have our optional practices, and I'm going to open it up. Okay, so basically we have a corporation and it sold its credit subsidiary at a gain of $237. Okay, that's great. Now, first they have a list of all the accounts and what those accounts had in it. This is before they take out the discontinued operations. And what we're required to do is to take this financial statement and now correct it and show the sales and cost of goods and all of that separately for the continued versus the discontinued operations. Okay, so one of the things that they show us is that it's over here on this side over here. Basically, the discontinued subsidiary accounted for 20% of the revenues. So out of the sales of $10,000, 20% of that was earned by the discontinued operation. So $8,000 is the sales from the continuing, $2,000 is the revenues that went to the discontinued. It's also 15% of all operating expenses was as a result of the discontinued. So all I'm doing in this problem is I'm taking the sales in every one of these items, and I'm going to multiply the sales by 80%, costs of services by 85, this one by 85, and then I'm going to go ahead and find the beginning of this problem. Okay, so wow, I did that really fast. One other thing I want to mention is after you get your sales and you subtract out all your operating expenses, you're going to get income from continuing operations before tax. In order to figure out your income tax expense, you're going to look at this data table, and as it turns out, it's 40%. So that's where they got that number, is you're going to simply take your income from continuing before tax, multiply that by 40%, there's your income from continuing. Now let's talk about that piece, discontinued operations at the bottom. There's two components or two items, let's say, that make up this instead of one line item on a trial balance. So the first line, what that comes from is all of the extra sales and expenses from our discontinued piece. So remember, 2,000 of the sales was because of the discontinued piece, 15% of the cost of services, 15. You take the sales, subtract out the expenses, and what you're going to get is a income from the discontinued component, right? So you've got that, but you want to show it net of tax. So what we're going to do is take that income that we get and multiply it. In this case, we can multiply it by 60%, 1 minus the tax rate, and that's what's going to get us the 44850. So notice it's already net of tax. Now the other piece is gain or loss on disposal. In this case, they've already sold them. So we have from the information that they sold them at a gain of 237. We take that 237 and again we multiply it by 60%, 1 minus the tax rate, and that's going to get our net of tax amount there. So we have two pieces, in this case income plus gain. So overall we have a gain on the disposal of the discontinued segment, and it's already shown net of tax. So that's the end of our problem there, and you've got one like it. It usually tends to be a little bit confusing the first time through it, so I just wanted to give this little overview of it.